In November 1910, 7 men boarded a private train car in New Jersey under cover of darkness. They used fake names. They traveled in secret. And over the next 10 days, meeting on a private island off the coast of Georgia, they designed a system that would control American money for the next century. This wasn't a heist in the traditional sense. No guns, no masks, no vaults blown open. But what these men created was far more profitable than any bank robbery in history. They didn't steal gold that night. They built a machine that would legally extract wealth from every American for generations. The meeting was secret. The location was hidden. And when the plan was finally revealed to Congress and the public, it was wrapped in lies about protecting the people, about preventing panics, about creating stability. But here's what they don't teach you in school. The Federal Reserve wasn't created to protect you. It was created to protect them. The bankers who couldn't compete, who couldn't survive the free market, who needed the government to guarantee their profits. This is the story of the Jekyll Island conspiracy. And yes, it was a conspiracy. They admitted it. This is the gold heist that never ended. To understand why 7 men had to meet in secret to redesign American banking, we first need to understand what American money looked like in 1910. The United States did not have a central bank. It had tried twice before. The first Bank of the United States, chartered in 1791, expired in 1811. The second bank, chartered in 1816, was killed by President Andrew Jackson in 1836. Jackson called it a den of vipers and corruption, controlled by wealthy elites who manipulated money for their own profit. He was right. And for the next 74 years, America operated without a central bank. Instead, the country had a decentralized banking system. Thousands of independent banks issued their own notes, backed by gold and silver reserves. If a bank made bad loans or overextended itself, it failed. Depositors lost money. Stockholders were wiped out. There was no government safety net, no bailouts, just consequences. This system had problems. Bank runs could spread like wildfire. Regional panics could spiral into national crises. But it also had one massive advantage: discipline. Banks couldn't take reckless risks knowing the government would rescue them. They had to stay sound, or they died. The market enforced responsibility. But for the largest banks on Wall Street, this system was a nightmare. They wanted to expand, to lend more, to take bigger risks. But without a central bank to create money and provide liquidity during panics, they were constrained. Worse, they were competing against each other. When one bank grew too aggressive, others could refuse to honor its notes, forcing it to contract or collapse. The system kept the biggest players in check, and that's exactly what they wanted to change. The trigger came in 1907. A financial panic swept through New York. Trust companies, institutions that held deposits but weren't regulated like banks, had made disastrous bets on copper stocks. When those bets failed, depositors panicked. Lines formed outside trust companies across the city. Runs spread to banks. Credit froze. The stock market crashed. The federal government had no tools to stop it. The Secretary of the Treasury deposited some funds into New York banks, but it wasn't enough. So the bankers turned to one man, J.P. Morgan. At 70 years old, Morgan was the most powerful financier in America. He locked the city's leading bankers in his library, refused to let them leave until they agreed to pool their resources, and personally orchestrated a rescue. The panic was contained. Morgan was hailed as a hero. But here's what the newspapers didn't say. Morgan and his allies had just proven that private bankers held more power over the American economy than the government itself. And that terrified both politicians and the public. Something had to change. The question was, who would control that change? The year is 1910. Senator Nelson Aldrich, one of the most powerful Republicans in Congress, has a problem. Aldrich is also one of the wealthiest men in America, with close ties to J.P. Morgan and the Rockefellers. His daughter is married to John D. Rockefeller Jr. He's not a neutral observer of banking. He's part of the system. And after the panic of 1907, he's been tasked with creating a proposal to reform American banking. But he can't just write a bill that hands power to Wall Street. The American public hates the big banks. Populist anger is rising. Farmers in the Midwest blame Eastern bankers for tight credit. Workers blame them for unemployment during panics. Progressives want to break up the trusts, not empower them. If Aldrich proposes a plan that looks like it benefits Morgan and Rockefeller, it will be dead on arrival. So Aldrich needs cover. He needs a plan that looks technical, scientific, above politics. A plan designed by experts, not bankers. A plan the public might actually accept. That's when he reaches out to Paul Warburg. Warburg is a German-born banker working for Kuhn, Loeb & Co., one of the most powerful investment banks in New York. He studied European central banks, particularly the Bank of England and the German Reichsbank, and he's been lobbying for years for America to adopt a similar system. Warburg is smart, connected, and most importantly, he knows how to make a central bank sound like it serves the public instead of the bankers. Aldrich invites Warburg and 5 others to join him for a secret meeting. The group includes Frank Vanderlip, president of National City Bank, the largest bank in America; Henry Davison, senior partner at J.P. Morgan Charles Norton, president of First National Bank of New York; Benjamin Strong, head of Bankers Trust; and Aldrich's personal assistant, Arthur Shelton. 7 men, representing roughly 1/4 of the world's wealth. The location: Jekyll Island, Georgia. A private resort owned by the richest families in America. Rockefeller, Morgan, Vanderbilt. The island has a clubhouse, staff, and most importantly, total privacy. No reporters, no politicians, no public. They travel under fake names. Aldrich is called Professor. The others use first names only. When they board the train in New Jersey, they pretend not to know each other. Staff on the island are told they're on a duck hunting trip. For 9 days, from November 22nd to December 1st, 1910, these 7 men draft the blueprint for the Federal Reserve System. And here's the thing. They weren't hiding because they were doing something illegal. They were hiding because they were doing something the American public would never accept if they knew the truth. What did these men create in those 9 days? On the surface, they designed a system that looked decentralized. Regional Federal Reserve banks spread across the country, not one central bank in New York. A Federal Reserve Board in Washington to provide oversight. Language about serving the public interest, stabilizing the currency, preventing panics. But beneath the rhetoric was a machine built to serve the banks. First, the plan allowed banks to lend more money than they actually had. By pooling reserves in the Federal Reserve System, individual banks could expand credit far beyond their own gold holdings. This wasn't a bug. It was the feature they wanted most. More lending meant more interest, more profit, more power. Second, the plan made the Federal Reserve the lender of last resort. If a bank made bad loans and faced a run, the Fed could provide liquidity, printing new money to keep the bank afloat. On paper, this prevented panics. In reality, it removed consequences. Banks could take bigger risks knowing they had a backstop. Third, and most importantly, the plan put control of the money supply in the hands of bankers themselves. Yes, there would be government appointees on the Federal Reserve Board. But the regional Fed banks would be owned by private banks, and those private banks would select many of the officials running the system. The foxes weren't just guarding the henhouse, they owned it. Paul Warburg later admitted the goal in his memoirs. He wrote, "The matter of a uniform discount rate was discussed and settled at Jekyll Island." Translation: the bankers wanted the power to set interest rates, to control the cost of borrowing across the entire economy. That power had always belonged to the market. Now it would belong to a committee of bankers. When the meeting ended, the group returned to New York with a draft plan. But they still had a problem. Congress would never pass a bill written by Wall Street in secret, so they laundered it. Senator Aldrich introduced the plan as the Aldrich Plan in 1912. It was attacked immediately. Progressives and populists saw exactly what it was, a banker's scheme. The plan died in Congress, but the bankers didn't give up. They just repackaged it. In 1912, Woodrow Wilson was elected president. Wilson had campaigned against the money trust, promising to break the power of Wall Street. But his key advisor was Colonel Edward House, a man deeply connected to the same banking interests that had met at Jekyll Island, and his campaign had been funded in part by those very banks. Once in office, Wilson supported a revised version of the Jekyll Island plan. The bill was rebranded as the Federal Reserve Act, written by Virginia Congressman Carter Glass. The language was softened. The structure looked more decentralized. The rhetoric emphasized public control. But the core was the same, a central banking system that would allow banks to expand credit, protect them from failure, and centralize control over money. The bill was passed on December 23, 1913, just before Christmas recess when most of Congress had already left Washington. It passed the House 321 to 75. It passed the Senate 43 to 25, and Wilson signed it into law. The bankers had won, and most Americans had no idea what had just happened. The consequences of Jekyll Island didn't emerge overnight. They unfolded over decades, but the pattern is unmistakable. First, inflation. Before the Federal Reserve, the U.S. dollar maintained relatively stable purchasing power. There were fluctuations, but over the long term, a dollar in 1900 bought roughly the same amount as a dollar in 1800. After 1913, that changed. The Fed began expanding the money supply. By 1920, prices had more than doubled. By 1930, the dollar had lost half its value. Today, a dollar buys less than 3 cents compared to 1913. That's not an accident. That's the design. The Federal Reserve was built to allow inflation, because inflation benefits debtors, and the biggest debtor is the government. Second, the boom and bust cycle accelerated. The Fed was supposed to prevent panics. Instead, it caused them. In the 1920s, the Fed expanded credit aggressively, fueling the stock market bubble. When the bubble popped in 1929, the Fed contracted the money supply, turning a recession into the Great Depression. Millions lost their jobs. Banks failed by the thousands. The economy collapsed. And the lesson the government learned wasn't to abolish the Fed. It was to give the Fed more power. Third, the consolidation of banking. Before 1913, the U.S. had thousands of independent banks competing against each other. Today, the financial system is dominated by a handful of megabanks. J.P. Morgan Chase, Bank of America, Wells Fargo, Citibank. These institutions are considered too big to fail, meaning the government will bail them out no matter how reckless their behavior. How did they get so big? The Federal Reserve. By providing cheap credit and acting as a safety net, the Fed allowed big banks to absorb smaller ones to take risks that would have destroyed them in a free market and to grow into the monsters they are today. Fourth, the explosion of government debt. Before the Federal Reserve, the U.S. government was constrained by gold. It could only spend what it could tax or borrow from real lenders. The Fed changed that. Now the government can issue bonds, and the Fed can buy those bonds with newly created money. It's a printing press for the Treasury. The national debt in 1913 was less than $3 billion. Today, it's over $34 trillion. That explosion was made possible by Jekyll Island. And here's the final consequence: the transfer of power from the people to the bankers. Before 1913, money was largely controlled by the market. People chose what to accept as payment. Banks that failed were liquidated. The system was messy, but it was accountable. After 1913, a small group of unelected officials working behind closed doors at the Federal Reserve gained the power to set interest rates, to expand or contract the money supply, to determine the value of every dollar in your pocket. That power was never voted on. It was stolen, legally. If you think Jekyll Island is ancient history, look at what happened in 2008. When the housing bubble collapsed and banks faced insolvency, who saved them? The Federal Reserve. The same institution created by bankers, for bankers, in 1910. The Fed created trillions of dollars out of thin air, bought toxic assets from failing banks, and ensured that not a single major Wall Street executive went to prison. Ordinary Americans lost their homes, their jobs, their savings. But the banks? They got bigger. J.P. Morgan absorbed Bear Stearns and Washington Mutual. Bank of America swallowed Countrywide and Merrill Lynch. Wells Fargo took over Wachovia. The crisis that should have destroyed them made them stronger, because the Federal Reserve, the system designed at Jekyll Island, protected them. Or look at 2020. When COVID lockdowns threatened to crash the economy, the Fed stepped in again. It cut interest rates to zero, bought trillions in bonds, and pumped money into the financial system. Stock markets recovered almost instantly. Asset prices soared. The wealthy got richer. Meanwhile, small businesses closed by the hundreds of thousands. Millions of workers struggled to pay rent. The wealth gap exploded. And who benefited most? The same banks and financial institutions that the Fed was created to serve. The pattern is always the same. Crisis emerges. The Fed intervenes. The financial elite are protected. The public pays the price through inflation, debt, and the erosion of their purchasing power. Jekyll Island isn't a conspiracy theory. It's a conspiracy fact. The men who created the Federal Reserve admitted it. Frank Vanderlip wrote in his autobiography, "I do not feel it is any exaggeration to speak of our secret expedition to Jekyll Island as the occasion of the actual conception of what eventually became the Federal Reserve System." They were proud of it, because they won. So what does Jekyll Island teach us? 3 critical lessons. Lesson 1. Central banks are not created to serve the public. They are created to serve the banks. Every central bank in history, from the Bank of England to the Federal Reserve to the European Central Bank, was designed by financial elites to protect their own interests. The rhetoric is always about stability, about preventing crises, about helping the economy. But the structure always benefits the insiders. When the Federal Reserve was created, it wasn't farmers or workers or small business owners meeting in secret. It was the richest bankers in the world. That tells you everything. Lesson 2. Inflation is not a natural phenomenon. It is a policy choice. Before central banks, currencies maintained value over long periods because they were backed by gold or silver. After central banks gained the power to create money, inflation became constant. The dollar has lost 97% of its purchasing power since 1913. That's not bad luck. That's the Federal Reserve doing exactly what it was designed to do: transfer wealth from savers to debtors, from the public to the financial system. Lesson 3. Secrecy is always a warning sign. When powerful people meet in secret to design systems that affect everyone, you should be very, very concerned. The men at Jekyll Island didn't hide because they were protecting national security. They hid because they knew the public would reject their plan if they understood it. And that pattern continues today. The Federal Reserve still operates largely in secret. Its meetings are closed. Its decisions are announced with minimal explanation. It is accountable to no one. And that is by design. Here's the unsettling part. The men at Jekyll Island didn't think they were doing anything wrong. They genuinely believed that concentrating financial power in the hands of experts, meaning themselves, would create stability. They thought the public was too ignorant to understand banking, too emotional to handle panics, too short-sighted to manage money. So they built a system where decisions would be made by the enlightened few. But what they really built was a machine for extracting wealth, a legal mechanism to privatize profits and socialize losses, a system where banks could take massive risks knowing they'd be bailed out, a structure that guaranteed inflation, debt, and the slow erosion of the middle class. Which brings us to today. Are we living in the world Jekyll Island created? Absolutely. The Federal Reserve is more powerful now than it was in 1913. It controls interest rates. It creates trillions in new money with the press of a button. It decides which institutions survive and which fail, and the American people have no say in any of it. The national debt is $34 trillion and rising. Inflation is eating away at wages and savings. The wealth gap is the widest it's been in a century. And at the center of all of it is the Federal Reserve, the institution created in secret by 7 men on a private island over a century ago. Jekyll Island shows us that the system was never designed to serve you. It was designed to serve them. And until people understand that, nothing will change. The Jekyll Island meeting wasn't a bank robbery. It was something far more sophisticated. These men didn't steal gold from a vault. They built a system that would legally extract wealth from every American for generations. And they succeeded. History doesn't repeat, but if you don't understand it, it will crush you all the same. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look. Drop a comment. Do you think the Federal Reserve should be abolished?